Well, today I want to talk about credit spreads, what they are, what the current spreads are, and what the market's telling us by those current credit spreads. Now, simply put, credit spreads are differences in yield between different types of fixed income instruments. So we could be talking about corporate bonds versus treasury bonds. We could be talking about sectors within corporate bonds like high yield versus investment grade bonds. And of course, we can look at that for any particular maturity. Now, in general, what these are telling us or what they're describing is credit worthiness. So if you think about the spreads widening, it's because credit worthiness is deteriorating in the eyes of the market. If the spreads are narrowing, then that means credit worthiness is improving in the eyes of the market. Of course, the actual and absolute level matters as much as the direction of the widening and spreading of these spreads. Now, let's look at triple B versus Treasury. Again, so this is kind of the lowest investment grade category versus Treasury. We see that it is at 116 basis points. That compares to an all-time low in 2018 of 115 basis points. Very, very similar to the all-time low. We can look at high yield versus Treasury. Here we see current spreads of 330 basis points. That compares to an all-time low again in 2018 of 316 basis points. Here we're going to look at the riskier high yield securities. So this is triple C and lower. We see a current spread of 636, and that compares to an all-time low of 627 in 2014. But what the market is saying here is that things really couldn't be much better because these things are very near all-time lows right now, which would imply that things are just going great. Now, let's also compare within the corporate bond space. So here we're going to look at triple B minus all the investment grades. We see a current spread of just 22 basis points. In fact, that is an all-time low. We saw that on Monday. Now, we can look at all the high yields minus investment grades. Here we're going to see a current spread of 236 basis points versus an all-time low in 2018 of 205 basis points. And let's finally look at triple C, kind of those higher risk, high yields minus investment grades. We see a current spread of 542. That compares to an all-time low of 520 basis points back in 2014. But again, the market's saying that things really couldn't be better because things are at, in fact, one of them is at an all-time low. So things really couldn't be getting any better. Question is, what's driving this? So one of the things, of course, would be, hey, the economic environment is just great. Things are getting better. Clearly, we're ending this pandemic. But the bottom line is things aren't great. They really aren't better than they were pre-pandemic. Certainly. That's the way I feel, and that's the way the employment numbers would suggest, et cetera, et cetera. So it, to me, doesn't seem like a justification to say, hey, things are at kind of the best levels they've ever been in terms of the economic environment. We can also think about earnings. Yeah, clearly things are better there. Lots of companies are massively beating expectations, but things could be better. In fact, some companies are doing really well, some are doing poorly, and that's something to consider. Now, I have some videos on that K-shaped recovery. Check out those videos by following these links here. But again, here, I don't think that earnings truly says things have never been better or are near all-time best things. So the other thing you might think about is, well, the Fed is clearly involved here too. So they are providing massive asset support. They are buying corporate bonds to keep yields really low. So this is having an impact on it. Now I have lots of comments about Fed and the central bank, et cetera. Check out all these videos here to listen to a lot of my thoughts there. Now, the Fed clearly is involved here. This must be impacting it too. This seems like the most reasonable justification for these spreads, but this has been happening for a while and spreads have narrowed from here. So I can't kind of rationalize why that would cause the continuing narrowing of spreads. Now, the other thing is, maybe investors are just being irrational right now. That is certainly possible. We've seen that over and over again. There are times when investors just are not behaving rationally. And I have a ton of videos about specific examples of what I deem to be crazy investor behavior. Please follow these links here and check those out. So that's it for today. Hope you enjoyed that. Happy trading. Thank you so much. I'm Brian Kozlowski.